This beginner forex mistake can blow your account very fast, and the particular mistake we are looking at is not calculating position size. Now, what really is position sizing? Position sizing talks about the percentage of your equity that is exposed to the market each time you're taking a trade. Not calculating position size is a major risk beginner forex traders engage in, because it removes control over how much money you risk per trade. Now, we can break it down in a simple way, and I'll be looking first at the dangers. Why is it dangerous for you not to use the right position sizing for your account when trading? The first reason is because you can lose too much on a single trade. Now, this is the major problem with a lot of beginner traders. Without position sizing, beginners often choose random lot sizes. This is very common with a lot of beginner traders. The place they trade now is a 0.1 lot, next trade is 0.3, the one after is 0.5, then they use 0.05, random lot sizes. This can be very, very dangerous to your account, because one bad trade can see your account blown completely. The second reason why it's dangerous, or is a mistake you make, by not using the right position sizing, is because your result becomes inconsistent. Imagine the trade you took with a 0.1 lot. Now, with the 0.1 lot, 10 pips is $10. With a 0.5 lot, 10 pips is $50. The same thing if it's a loss, is the other way around also. 10 pips with 0.5 is minus 50, 10 pips with 0. So your result is going to be inconsistent. You will not be able to manage, your trades effectively, nor get the right result you expected to. Now, some trades risk small amounts, others risk large amounts. Even with a good strategy, this makes performance unpredictable and unreliable. So your performance becomes unpredictable and unreliable because you are not consistent with the lot size or with the position sizing you are using for each of your trades. Third thing that this leads to is emotional trading increases. You begin to trade with emotions and not with logic. Big unexpected losses lead to fear and revenge trading. Now, that's the reason. Now, you took a trade on a 0.1 lot, you got a minus 50 pips, you got hit minus 50 pips, stop loss, you're out of the trade. Then you take another trade, you use 0.3 or use 0.5 because you want to take revenge on the market. You want to recover from the previous lot and loss and had additional profit. That becomes emotional trading. Revenge trading is emotional trading. If you are practicing revenge trading, I want you to stop now, because it's going to kill your account at the end of the day. Traders start making decisions based on emotions instead of rules. See, I always tell my students, identify your trading rule and stick with it. No matter what is happening, still stick with it. Over time, you see that you become more consistent. Discipline is one of the biggest mistakes that beginner traders make. They are not disciplined. Many beginner traders find it very difficult to be disciplined. Number 4 is that good strategy can still fail. There is no holy grail in trading. So if you have a strategy that works for you and fails, that doesn't mean the strategy is bad. Things may not just work well for that strategy at that point in time. Even a profitable trading system can lose money if trade sizes are too large. Your strategy is good, but then your position sizing is too large. So when that strategy does not deliver, see, any strategy that can deliver a 60% win rate for you is a good strategy. Very good. If it can deliver, you only need 60% win rate to be successful as a forex trader. When you're talking about 70-80%, yeah, that's excellent, super excellent. But just to be profitable, you only need a 60%. But even with that 60%, the times you have a loss, if you are not using the right position sizing, your account can still get blown in the process. Now, finally, is that you are not going to have long-term account protection if you are not using the correct position sizing when trading. Because without position sizing, there is no structure to protect your capital. You see, position sizing will deliver you from a lot of sleepless nights and headache when trading. So if you don't use the right position sizing, your account can be slowly or quickly wiped away. Now, in real life, let's look at a real life scenario. For a beginner trader, you win a few trades and you feel confident. You are so happy. You have this, feeling that yes, I'm doing well now. Then, out of that success, you now go ahead with your next trade. You increase your lot size. Then, to your shock, the market reverses against you and you end up having a big loss. Now, in order to try to recover that big loss, what happens? You trade a bigger loss, lot size. That is, you are taking revenge. Then the trade also becomes a losing trade. Your loss gets bigger. Before you know what is happening, your account starts dropping gradually. eventually this can lead to account destruction or account depletion. So as much as possible, make sure you use the right position no matter what. Stick with one lot size. That's all I've been saying so far. If your account can accommodate 0.1, stick only with 0.1. Stop jumping 0.1 today, 0.5 tomorrow, 0.7, 0.01. No, stick with the one that your account can accommodate. Now, for professional traders, position sizing help them to manage risk effectively. It's a survival mechanism and it's a tool for consistency. So if you're a beginner, you are planning to be advanced, start acting like advanced trader now. Now, as I begin to round up in this video, the best way to manage your account with the right position sizing, if you have a $100 account, never exceed 0.01 lot in your trade. If you have a $200 account, never exceed 0.02 lot. For $500, never exceed 0.05. For $1,000, never exceed 0.1 lot. I mean per trade. And don't have more than 2 or maximum 3 trades at a time, with these lot sizes that I've mentioned. If you're to use a standard lot professionally, it should be a $10,000 account. I know some of you will argue with me. Don't worry. You want to learn the hard way. Go ahead. Jokes apart, make sure you use the right position sizing each time you are taking your trade. Now, not calculating position sizing means you are trading without risk control, and in forex, it's one of the fastest ways. It's one of the fastest ways to get your account blown, and you start all over again. All right, if you've enjoyed this video, you've picked 1 or 2 things that will help you become a better trader, go ahead and like this video. Drop a comment in the comment section. Share this video so that other beginner traders can also see it and get to learn a thing or 2 about how to become a better trader. Most importantly, click on the notification bell and the subscribe button so that you can get notified when I drop another video like this, which is coming very soon. I'll see you in my next video. Take care. Bye for now.